Welcome to part 2 of the video on flexed budgets and basic variances. In this video we should be able to go through perhaps all, but if not all, some of the variances that we've found from the previous video on this table showing the flexed budget and the actual results and the variances that have resulted. And so the first variance to take a look at is the sales variance. Here it's showing as 5,500 adverse, so we're just going to take a look at it and look at the two variances that we take from the sales variance. And so the first variance to look at is the sales price variance. Now there isn't much to be said about this, I suppose, because we've already calculated it. It's the total variance. But anyway, this is it. So we take a look at the actual units sold. The way I do it is that this is from the flexed budget, and so the actual units sold by the standard price shows that we should have had revenue of 380,000, but the actual revenue was 374,500. The actual revenue is less than the flexed expected revenue, and therefore the difference is an adverse variance. Going back to the table, we already see the adverse variance there, so it's already been calculated, and the way I just showed you is just a tabular format of looking at it. And the second variance with sales is the sales volume variance, and this is originally calculated in units and then converted into a pound value. So the original sales from the original budget, the original planned sales, were 4,500 units. The actual sales were 4,750 units, giving extra sales of 250 units, and it's not necessarily favourable there, but extra sales should mean extra revenue, which should mean extra profit. So the variance, this is the variance in units, this is the variance in pounds, and that's quite simply the number of units times the standard profit per unit. Well, that's 250 units of the variance. The standard profit is the sales price minus the cost price, which gives £13 per unit. Multiply that by 250 and you get a favourable sales volume variance of £3,250. And so the effect of selling an extra 250 units gives us an extra £3,250 expected profit. And if you take a look here, if we take 61,750 and deduct 58,500, we get the difference of 3,250, which is the difference in the flexed budgets of selling an extra 250 units. And so we'll take the sales volume variance and put it into our operating statement. The operating statement is a statement which helps to explain the difference between the budgeted profit, the flexed budgeted profit, and the actual profit. So here we can see the original budgeted profit was 58,500, and we had a sales volume variance which was 3,250 favourable. So this will give us a new profit of 61,750. However, the sales price variance was 5,500 adverse, meaning that we didn't get what we expected to get from the sales revenue from the flexed budget. So I'm going to put the 5,500 into the sales price variance row. It is adverse, which will give us a new profit of 56,250, which isn't the correct profit at the moment because the actual profit was 55,292. We need to look at the other variances first. So the next variance that we're going to look at is the materials variance, the cost variance, the materials variance. Well, we can see that the flexed budget has a figure of £79,500 for materials, and the actual results were that we paid £82,658 for materials, and that gave an adverse variance of 3,158. We can summarize that in a table here. To see the direct materials total variance, we take the value of the materials that should have been paid for from the flexed budget and we compare it with the actual result, and this is where we see the £3,158 adverse variance that we saw in the table. So we're going to analyze the total variance and it's going to be analysed into the direct material price, also known as expenditure variance, and also the second analysis will be the direct materials usage variance. And so the materials price or expenditure variance, it looks at how much should the material from the flexed budget, how much should it have cost, and how much did it actually cost. Well, the way I remember all of the price or expenditure variances is by thinking of the unit of purchase, and that's a nice way that I've learned to remember it. So the unit of purchase we've got are kilograms, and from the table we know that 16,050 kilograms were purchased at a cost of £82,658. So I call it reflexing the budget using the actuals. So 16,050 kilograms of material at the standard cost of £5 per kilogram should have cost £80,250. But they actually cost 16,050 kilograms of material actually cost 82,658. So taking one from the other, we've got an adverse variance, or rather we've got a variance of £2,408, and it is adverse because we spent more than we expected to spend. And so that's the direct material price or expenditure variance. The expenditure means what did you spend on it. And the second analysis we're going to make on the total materials variance is the materials usage variance. This time, the way it's done, the way I look at it is I consider it as units of sale, because I find it can be confusing to think of units of output or units of input and so on. Units of sale, it means completed units. So the actual number of units completed and ready for sale are 5,300 units, and the standard usage, the standard number of kilograms per unit is 3. So really, those number of units for sale should have used up in kilograms, because initially the usage variances are measured in kilograms and then converted into pounds, should have been 15,900 kilograms and was actually 16,050 kilograms. So again, it's adverse because what should have been used in creating 5,300 units took 150 kilograms more than expected according to the reflexed actuals here. So the variance of 150 kilograms at £5 cost per kilogram is a £750 adverse variance. And we can check our analysis totals by checking against the total variance. Here we put the price variance, which was 2,408 adverse, and we put the usage variance, which was 750 adverse, and we add them together and the total is 3158 adverse, which balances with the total variance there. And so before we move on, we're going to transfer these variances over to the operating statement. Both of the analysed variances were adverse, so the first one is materials price variance of 2408 adverse, and I've just entered the material price variance into the adverse column, 2408 adverse. And the second materials variance was the materials usage variance, which is £750 adverse, and so I've just entered the £750 into the adverse column of the operating statement, and we'll keep doing this as we progress through the other variances. So what do these analysed variances mean? Well, the price variance is adverse, and it's telling us that we paid £2,408 more than we expected to pay for the price of the materials that we purchased. And it's also telling us that in pounds we used £750 worth of material more than we expected to use. One explanation for the price variance could be that the purchasing manager bought more expensive, higher grade or higher quality material with a view to improving the yield or improving the output or improving the usage, so that if he paid more for the material, then its usage variance would be favourable. But clearly that hasn't worked out in this case. And so the next variance that we're going to be taking a look at is the labour variance. Here we've got the original budget of 160,000. We've got the flexed budget of 169,600, and we've got the actual results, the amount paid for labour, 167,100. And because it was less than the flexed budget, then there was a total variance of 2,500 favourable. So to avoid flipping between screens, I've taken some information. So from the standard cost card, I've got labour at 4 hours at £8 per hour, giving £32 per unit. And the number of units made were, for the actual results, 5,300. The number of hours paid were 20,750. The number of hours actually worked were 20,100. The number of hours paid but not worked, idle time, was the difference, which is 650 hours of idle time. And here I just copied over the original budget, or rather the flexed budget, and the actual results and the total variance. So there are three variances for labour. The first variance is like materials price variance or materials expenditure variance. It's called the labour rate variance, and it looks at how much did the company have to pay for the labour that it purchased. The second variance for labour is the usage variance, and it's called the labour efficiency variance, and it measures, like materials measures how much wastage there was of materials. The labour efficiency variance measures how fast or slow the workers worked in producing the output of the production run. And the third variance, if you have it at all, is known as the idle time variance, which really isn't a variance at all. It's just a direct calculation of the cost of the idle time, but it's called idle time variance, and it's always adverse. So here is the labour rate of pay variance, or the expenditure variance. It's a price variance. The way that I look at price variances is I always think of the unit of purchase. Now the company purchases labour in units of 1 hour, so the unit of purchase is hour, and in total the company paid for 20,750 hours at the standard rate. If we reflex, I'm calling it reflex in the budget. At the standard rate, the company should have paid £166,000 for labour, based on 20,750 hours at standard cost. But actually, those 20,750 hours cost the company £167,100. And because it cost more than expected, the variance is adverse. As it happens, there's a negative figure before the 1,100, but there doesn't have to be. It's adverse because the company paid more than expected. And the next variance to look at is the labour efficiency variance. And as with the usage variances, the first column is, the way I remember it, is the units of sale. That is completed goods ready to be sold, manufactured goods during the period. And each of these completed manufactured units, according to the standard cost card, should take 4 hours per unit. It's a standard, because we are talking about labour, the unit of purchase is going to be hours, and the standard cost card says that each unit, each completed unit, needs 4 hours to be completed. So if you reflex the budget using actual figures, we can see 5,300 units were actually produced. The standard cost card says that each unit should take 4 hours, so in total 5,300 units should have taken 21,200 hours to produce. A note to remember about the efficiency or usage variances: the variance is first of all calculated in units of purchase, and then from the totals that are found, it's then the hours or the kilograms are then, using the standard cost, converted into a pound value. And so also the next thing is, we found out the number of hours it should have taken to produce 5,300 units, And how many hours did it take? It took 20,100. Notice those hours are the actual worked hours. Doesn't mean the idle time hours. And so the final variance is the idle time variance. There were 650 hours of idle time. This is because the hours that the company paid for was 20,750, and the hours that were actually worked was 20,100, leaving 650 hours of idle time. There could have been a machine breakdown, we don't know. Anyway, the total number of hours of idle hours is multiplied by the standard cost per hour, and that gives a variance of £5,200 adverse. Idle time variances are always adverse. Coming back to the number of hours that were actually worked, that we put in here 20,100, the reason that it's 20,100 is because that plus the 650 of idle time hours gives the total number of hours. And a quick check on that shows the company actually paid for 20,750 hours. The workforce were working or manufacturing for 20,100 hours, and there were therefore 650 hours where something had gone wrong and the workforce were idle. And looking at the two variances, the efficiency variance and the idle time variance, if you remember, we put in the number of hours worked in the efficiency variance, and then later we went on to calculate the idle time variance. If you add those two figures together, it gives the total of 20,750 hours, which is what the company paid or purchased in labour. So it's always nice to check. The total variance was 2,500, and so our analysis figures came to: the labour rate was 1,100 adverse, the labour efficiency variance was 8,800 favourable, and the idle time variance was 5,200 adverse. And when these three sub-variances are added up, then they balance with the total variance from the original flexed budget and the actuals. So what do these variances mean? Well, the labour rate variance is adverse. This means that for whatever reason the company paid 1,100 more in labour than it would have otherwise expected to. The labour efficiency variable being favourable tells us that the workforce worked faster than otherwise expected. And the idle time variance tells us that this is the cost of the downtime, the idle time. As I said, there could have been a machine breakdown or something could have happened. The workforce was available for work and being paid for work, but for whatever reason they couldn't work, or they couldn't manufacture, they couldn't produce. So that's the cost of idle time. So now that we've got the labour variances, or the labour sub-variances rather, let's continue to build the operating statement. All I'm going to do is type in the labour rate variance, which was adverse, the labour efficiency variance, which was favourable, and the idle time variance, which, because it's idle time, it's always adverse. And here they are: the labour rate variance 1,100 adverse, the labour efficiency variance 8,800 favourable, and the idle time variance 5,200 adverse. And the remaining sub-variances that we're going to look at are the variable overhead price variance, the variable overhead efficiency variance, the fixed overhead price variance, and the fixed overhead volume variance.